All right.
Welcome to Navigating Your Retirement with your host, Travis Chance. And this morning, folks, we are going to switch positions. If you're wondering, like, why is Tony not introducing the show? Well, this morning, I'm giving him the hot seat. He's actually going to be asking me questions off the cuff. We're going to see where this goes. This could be some good information, or Tony, it could go down in flames. We'll see what happens. But good
Yeah.
morning.
Good morning, Travis Chance. Thanks for having me on the show. And this is interesting. You have no idea what topic I'm going to bring to the table. Normally, you pick a topic
I have no notes. I have
and let
I have
me
no
know
idea.
what to ask you about, and you take it from there. But today, I picked a topic, did not tell you. Listeners, Travis has no idea what I'm going to ask him about. So I'm going to start with the current news in the financial world, and that's the Fed lowered interest rates last week or this past week. And, this has been a long time coming. Everybody said they would do it. They finally lowered the interest rates. First of all, I'd like your take on that. But then the question for our listeners is, how does that affect our listeners? So take it from there.
So that's a loaded question, and that this is going to take a minute.
Yep,
So
yep.
because it's got multiple
Yeah,
parts. Okay, first and foremost, you are correct. Fed lowered rates. The dot plot actually had a rate increase. I don't know if you saw that. One of the Fed governors actually advocated for a rate increase.
wow.
That was actually a bit of news that kind of went under the
I didn't hear that.
radar, so to speak. So that was interesting. Number two, um, the impact. What is going to happen now? So, Tony, and just because I know you and I have talked about this, the Fed can cut rates all they want to on the short end. They can't cut rates on the long end. The long end, the 10-year, longer term bonds, those are the ones that I really think everyone they correlate to the Fed's cuts because they think that because interest rates, and I see real estate brokers post online and I want to email them or text them and be like, hey, you really probably need to do a little research before you put that out there. They're thinking that this is going to mean rates for mortgages are going to start coming down. Mortgage rates are going to fluctuate. They're going to continue to go up and go down because the 10-year is the basis for most of those, not the short end. How this is going to impact our listeners, actually, in the beginning, it's going to be what? CDs, money markets, liquid accounts, stable value type accounts. Those are actually going to start seeing the interest rate come down. Usually, it's going to be proportionate, right? If you see a quarter point, and just to give you an example, let's say you were getting 4% on your money market account, your bank, because that's really the entity who's going to be impacted by the rate reduction, they're going to probably give you 3.7, 3.75. It's going to start coming down.
Sure.
So I
The
think for our
short-term principal
yes.
protected accounts that a lot of retirees or people
Yeah,
planning
a
for
lot of
retirement
retirees. There's $7
that
trillion
rely on.
and I think last estimates I heard from Charles Schwab, there's $7 trillion in assets in those types of accounts.
Yeah, like
More than the
like a
financial
MIGA,
crisis.
which is a multi-year guaranteed annuity, which is like kind of like a bank CD on steroids. So you've got
The
CDs,
CD insurance
fixed
buying
index
insurance.
annuities, some safe money options where you want the rates. It's in your best interest for the rates to be higher in that case because you want to make more and keep up with inflation. Is that what
Sure,
you're saying?
sure.
But they're going to lower because of this. So that's a
Sure.
negative to lower interest
It
rates,
is.
right?
Now the good part is, and there's some argument, whether this is priced in or not. And let's face it, I think a lot of it was. It usually means when the Fed starts cutting rates. If you look at historicals of where the market goes following that, that's usually positive for the market. Now,
Yeah.
how much and to what nth degree, I don't know, and I'll tell you why I say that. Uh, I was fully prepared after the rip and the run that we had been on for the volatility to go back to the benchmark and to the
Yeah.
norm for September,
I think
and
a
we
lot
have
of
not.
people were.
We have not. We have actually plowed into and through September thus far
And hit record
instead of
highs
yep,
again.
instead of actually seeing a pullback. So what I would caution everyone on is when you see these headlines about reducing interest rates and the Fed's cutting, don't get overzealous and don't get overexcited. It's probably not going to impact you the way you think it is.
Sure.
Um,
So I hear out from everybody. So your take is it's kind of a hot take, Travis, is that reminding people that your mortgage rates, everybody probably won't run out and buy a home because of this, because 0.25% probably really won't affect mortgage rate, doesn't have a direct effect because it more directly affects short-term borrowing, is
So,
what you're
all right,
saying.
let me see if I can explain it a little bit more simply. Think about it like a seesaw, Tony. The further out you get on the end of it, the more bounce you get on the other end, right? If
Sure.
you're a little bit closer to the middle, you don't see a lot of creep, right?
Sure.
You don't see a lot of up and down.
Good analogy.
So if the Fed now is on the path of cutting rates, am I saying that there's going to be no increase? No, that's not what I'm saying. What I'm saying is don't think it's dollar for dollar and all of a sudden you're going to see mortgage rates come down a quarter point or a half a
Right.
point or
Right.
1%. That's just likely not to be the case.
Right. Exactly.
Yeah,
Yeah.
and those are the ones I think everybody, because I mean, I'll be very frank with you. I've actually had that conversation with several clients over the last few weeks leading up to this, and then since the rate cut about, should we go ahead and refi our home? Well, folks, if you're going from a 6.5 to a 5 3/4, and going from a 30 to a 15 year, or if you're getting some meaningful reduction, maybe, but you need to make sure that you look at the underlying fine print and see what it's going to cost you to refi that. If you got to pay closing costs, you got to pay all these other costs. It may not actually work out to your benefit.
Yeah,
So
it has to be a decent drop. There has to be a significant
yeah, I
savings, like,
wouldn't I wouldn't do it for, $50, 75, $100 a
no.
month. But, if you can knock off, two, three, $400 a month, yeah, that's probably not a bad
Well,
idea.
when my wife and I, and this has been many years ago, showing my age, bought our first house, we lived in Goodlettsville, Tennessee, in the Nashville area, and we
Mhm.
bought our first home when we first got married, and we lived down there, or there. We interest rates, we got a deal at 9.2% on our house. That was a deal back then.
But
Like, and we
think
were
about what
excited.
prices were back then.
Yeah, really low.
Yeah.
I mean, crazy compared to now. I think we bought that house for $120,000, and it was a decent brick home. I mean,
Mhm.
it was crazy. This is a while back. But then interest rates started coming down, and we refied at 5.
Mhm.
And then when we moved back up here, we bought a house, and I don't know what we were at, 4 something. But then we refied it when the interest rates hit about 0, we refied at 2.9%.
Mhm.
So it's not always corollary. The Fed dropped interest rates to at one point we were at almost 0, but mortgage rates were still at 3. Right? That just
Well,
shows you the perspective. It's
but
not dollar for dollar.
But
Uh,
keep in mind, Tony, what was the Fed doing at that time? They were quantitative easing. They were
yeah,
growing their balance sheet, and they
yeah,
were actually buying the 10-year and the longer term treasuries
it's
to
true.
bring down interest rates on the long end.
Right.
That's the
The
one
difference.
thing that people
Yeah.
are not, I don't think, are being very clear about is
Mm,
the Fed, when they think and hear Fed's cutting rates, the Fed can cut the 10-year, but they have to increase their balance sheet, which had gotten to like $9 trillion. And they have slowly started to bring that balance sheet down, which is why you're not seeing that long end come down. It's actually creeping up. So they're lowering it on one end, but they're reducing their exposure on the long end. So interest rates are basically pointed like an arrow up and to the right. I mean,
yeah.
it's not it's not the same scenario that we had 20 years ago,
Yeah.
or excuse me, 15 years ago,
Yeah.
10 years ago. It's just not the same.
But the point is if you're gonna refinance, make it worth it. Like when I mean,
Absolutely. Make
our
sure the
current
juice
house
is worth
is
squeeze.
our current loan is at 2.9. I
Yeah.
mean, yeah, that and people would die for that nowadays.
Mhm.
But when we refinanced, it was a significant savings,
Right.
and they were waiving closing costs. So, but you have to add all that up. I don't think the quarter of a point, like you said, you make a great point. That quarter of a point lowering is on the short end, and I don't think it's going to impact the mortgage market enough to the long term, the 30-year loan enough to make it worth refinancing for a lot of folks at this
It's
point.
going to be a tough sell for a lot of people.
Yeah. Yeah.
What, Tony? What's your next question? That was a pretty fun little
Right.
back and forth.
But one positive, let's go over there's another positive to the interest rates lowering though, the short term, and that's maybe credit card rates will come down, right?
That's a
Like
possibility,
certain debt
but
debt
you
interest
know,
will come down.
I think that's a remote possibility because here again, uh, during the financial crisis, which is absolutely ridiculous. During the financial crisis, if you remember when I think it was Dodd Frank, and I may be wrong on this, so little grace here, but one of the financial reform acts and one of the things that happened in that mid 2000s, late 2000s was previously there were limitations on what credit cards could charge you,
Yeah.
and now there are not.
Right.
And that's
You'll
the
see them at
reason.
30%.
Yeah. So here's the thing. Insurance or credit card companies are literally able to set their own rate. Do you really think that they're going to drop your rate dramatically? Heck no.
No, no.
So there again, I'm a free market guy. I'm not trying to get in the socialism business and tell companies what they can and can't do. But there again, if we're willing to continue to accumulate debt and pay those high interest rates, then companies are going to continue to charge those interest
To
rates
take
because they're going to be
advantage of it.
like, the market says I can.
It's
So
loan sharking, yeah, at some point. I mean,
it's
these
100%. It is
30%.
legalized arm breaking loan sharking.
Because I remember, back in the day watching movies from the 70s or 80s, the crime shows, and there'd be a loan shark, and they'd be, or the mob would be loaning up money and having loan sharking. It's just like, we're going to charge 30-40%. And I'm like,
Mhm.
credit cards are getting pretty close to that right now. So,
Or like it's everyone's seen the movie Rocky,
yeah.
or most of us have.
Well,
Whenever
yeah.
Rocky
Hope
goes
so.
down to the docks and he tells the guy, "Okay, I got to break your thumbs." The boss says, "I got to break your thumbs." That's what it feels like when you pay your credit card minimum payment each month. Is the Visa says, "I got to break your thumbs."
Yeah, exactly. Well, hey, the last thing here I wanted to ask, and it ties into what we were talking about a little bit, but you just got back from a big conference where you saw some really key speakers and rubbed elbows with some of the top advisors like yourself in the country, financial advisors. Brian Belsky of BMO Bank, the head strategist, the financial strategist for BMO was there, Brian Belsky. You talked with him and
Gene
heard
Munster
him.
from Deepwater.
Yeah. So, yeah, exactly. So, these are A-listers you were rubbing elbows with and talking to people. People were picking your brain. So, on the investment side, the markets, we've seen record after record. If I pull up CNBC or Fox Business News, the headline says S&P breaks another new record. We're up over 6,600, right?
Mhm.
And I know that it goes up and down, but um, it's been pretty consistently up for a long time, and that's not what people predicted at the beginning of the year. They said maybe flat. They predicted by the end of the year we'd be pretty much even, they thought. A lot of the talking heads. So what's your take on the markets? Now, I think that they knew the Fed would lower interest rates. So that's why before they even made that announcement that the market went up and hit record highs, I think that helped. What's your take on that?
So the market, and once again, I'm glad you preface that with what is your take, because I have an opinion. Everybody has an opinion, but
Right.
here's
And
mine.
this isn't personal financial advice.
Right.
This is just your opinion on
Yeah, it's just my
what might
opinion
be
on
happening and what's been going on based on what you've heard from other experts and what you see happening out there.
so what Belsky says is I think is 100% true. You know, stocks lead the economy. Economy and earnings are really what drive stocks, right? Because if the economy's good, people are buying, and I'm probably getting that wrong, and he'd probably butcher me and if he saw me in public. But you know, essentially what he's saying is the better people feel, the more they spend.
Sure.
The more they spend, the more earnings companies have. You know, the economy goes same way.
Yep.
Um, we are seeing unemployment start to
Creep up.
creep up.
Yeah.
You are seeing more and more jobs being lost, or people filing for unemployment benefits. So one of the things that was the common theme pretty much by everyone that I heard speak, because we heard Double Line Capital, we heard from BMO Capital, we heard from Charles Schwab, Liz Ann Saunders, we heard from Deepwater and Gene Munster. And the common theme I felt like from that meeting was we will probably see a jobs recession coming up over the next 12-24 months. I think that is the consensus. Now, is that guaranteed, locked in stone? Is it going to happen? I don't know. I really
Right.
don't, because there's 1,000 things that can go right or wrong that could either make it better or make it worse.
Right.
I think the main point from all of those were, though, however, is there is significant value and significant opportunity for those out there who know where to dig and where to look. There are assets out there that are probably going to have a really rough go of it. One of the things that we have seen is this year specifically, just because of the dollar coming down, is we've seen international stocks do better. And if you take what and I actually had to get them to explain this twice. So basically, they're taking the value of the dollar and the earnings from the companies over in Europe. And whenever you calculate those together, that's the reason you're seeing this massive outperformance. It's not necessarily because a lot of these companies have massive earnings that have outperformed our stocks. It's the combination of the devaluation of the dollar and the performance of these equities. So will that continue? Because I think there was a big push for people to be like, oh, well, why are we not in international stocks? It's because they've been dogs for the last dozen years.
Right.
Now, it's not to say you shouldn't have any in an allocation, but
Right.
I'm kind of like Warren Buffett in the fact that I wish I was like Warren Buffett, but I'm kind of like Warren Buffett in the fact that, Apple. I mean, Apple, there is no more of an international company, in my opinion, than Apple. Why?
Right.
Because they do just as much, if not more, of their business outside the US as they do inside the US. So
Right.
that's my preference, is focus on high quality companies, companies that really have massive balance sheets, cash on hand, that can weather the storm, that have international exposure. And because in order to get that continued outperformance, then you got to think that the dollar is going to continue to plummet the way that it has over the last year. And I don't know that I'm in that camp. So I think the main consensus is U.S. for the most part was kind of the preferred class or sector of stocks versus emerging and international. And I do think that's probably not a bad way to be. Now we may start adding some additional positions, but we're still going to have our core, right?
Yeah.
Still going to have those 55 stocks that we feel like are going to be good bellwethers pretty much in any market. We could be wrong. I mean, just like, United Healthcare had the big dust up a few months back when they had the investigation that basically caused the stock price to just plummet. I
Yeah.
mean, they're the best in breed, best in class. How do you not own them if you have healthcare? But there again, you can't plan for things like that. Those are going to happen, and you just have to kind of weather the storm.
Yeah,
That's
their
why you bolt
CEO
50
being
or
shot
55,
and all the
not 20.
negative publicity. I
Right,
mean, these are black swan events that can
right.
affect, and so you never know when something like that's going to happen. But that's why you work with a trusted financial
So
professional like
getting
yourself.
back to put a bow on it, was a long-winded answer to say this. If you are taking, in my opinion, if you're taking considerable distributions from your portfolio to maintain your lifestyle in retirement, now is probably the time to reassess what you are doing, because we are at all-time highs, right? You've never been here before. No, none of us have. So if you are overburdening your portfolio with distributions, you need to really sit down with us, with someone, and let them help you figure out, okay, what happens if we do get that 15, 20%, 30% recession over the next 12 to 24 months? Is that going to be completely detrimental and long-term damaging to our portfolio, or is that something we're going to be able to weather? If you're not taking it, because Tony, a lot of our clients are income producing, so that's why I'm kind of gearing it back to that. If you are not taking a significant amount, then it's probably time to think about a different asset or different asset classes, taking some profit and rebalancing.
Sure.
And that's just good portfolio management. So I think the long-term consensus is still bull market, cyclical bull, or secular bull. There could be a cyclical bear. Just basically, markets are going to correct at some point. We all know it, right? We're going on about 4 years since the last one now. They typically happen every 4 years. I mean, statistics, just like September, do we know it's definitely going to happen? No. Is it logically and likely? Maybe. So I just think being prepared is better than being unprepared. Just like the Navy SEAL mantra is, and I heard it from the main stage. One of the gentlemen who spoke was a retired Navy SEAL, and he said there's two types of people. There's trained and there's untrained. So there's prepared and there's unprepared.
Right.
Don't be the unprepared.
Right. And that's where you come in, because you have access to, you can pick up the phone and talk to the president of, your investment company
Of the United
and
States,
the
I
scene.
donated that much.
No,
I'm just kidding. I can't back that up. I'm just kidding.
not the president of the United States, the
I
president
bought
of
the
the
watch.
investment company, the senior portfolio manager, and say, hey, you know, um, I got a client. We need to diversify or take advantage of the record highs in the market and re-diversify a little bit. And you have great offerings like the digital portfolio, the core select, which is kind of the S&P 500. There are a lot of options out there, but I think the digital select is a great portfolio, and you have access to many, many of these, and you're working with professionals, and you have third party money managers that you work with, and you're actively involved. I think that's so great for your clients and so helpful, rather than just leaving your money sit in a 401k and you have no idea what's going on, right?
Tony, I think the good part about the relationship with us and Grady is this: is we serve two different capacities, right? For us, it is about the macro, making sure our investment strategy is sound, making sure that our tax strategy is sound, making sure we have a plan for estate purposes, for healthcare, because any one of those could derail your retirement, and you have to be prepared for all four.
Yeah.
As far as what Gradient does, and we have other partners as well, but I'm just specifically referencing them because you just said it. What Gradient does is Gradient gives us the ability to have the back office, that if I had to do that and what I do for our clients all the time, I would never see my family. I'd be working 120 hours a week, right?
Right, right.
But I also don't want to shortchange anyone, and having a professional group that backs us up allows them to have their cake and eat it too, so to speak, because they get all the benefits of the planning side with us, and the ability for us to have good portfolio management and marry the two. And that is usually going to work out really well for most clients. So, there's no guarantees out there. I mean, death and taxes, the only two guarantees we have. But once again, there's prepared and there's unprepared, and we like to be on the side of prepared.
Yeah. There you go. I love it. Well, that's a great show right there, Travis. Listeners and viewers, thanks for tuning in. But before we go, Travis, let our listeners out there know how they can get a hold of you and set up a no charge, no obligation consultation.
Absolutely, Tony. Once again, we end the show the same way each week, and I want to say this first and foremost. If you're a client out there listening, first and foremost, thank you for trusting us to be your trusted advisor. But if you're also a client, you know that there are people out there that are in the position you were in prior to finding us. And I would like for you to take a moment and hit the forward button on this email and forward this to 1 of your colleagues, friends, relatives, someone who you know is not getting the level of detailed advice and care that you're getting. That's the best gift. It's coming up on the holiday season. That's the best gift you're going to be able to give someone for Christmas is financial stability and financial security. If you're out there listening and you don't have a financial advisor, or you do have one but you feel like you don't, that's why you need to give us a call at 877-269-0839. That's 877-269-0839. You can follow us on Facebook. You can find us on LinkedIn. You can also, we have our classes, which are starting this week, and we have offerings in the Savannah area, the Bluffton and Beaufort and Hilton Head area, and the Statesboro area coming up. So you may want to sign up for one of those and have a 4-hour session of retirement readiness, right? Come in and figure out and learn things that you didn't know you didn't know. That's the only way to actually get the power in your hands, is to find out what are the things I should be prepared for, what are the things I have prepared for, and how do we bridge the gap. So 877-269-0839 for more information.
All right. Thanks, Travis. Listeners, thanks for tuning in. That does it for today's episode of Navigating Your Retirement with our host, Travis Chance.